Today, we're excited to present this CCRI project, the Columbia CompState Rent Index. Quick introduce myself. My name is Wayne. I'm the Senior VP of Data at CompStak, and I want to welcome Stijn from Columbia Business School.
Hello, Wayne. Good to be with you all. Thank you for having us.
So, without further ado, let's get into the introducing the CCRI. So the Columbia CompState Index is a free and widely accessible constant quality rent benchmark that measures the effective rent across the U.S. What is constant quality? I think we'll dive into that later. But I want to highlight that this index is national available. We have a national index for office, industrial, and retail sector. Not only on a national level, we also have the indices on the MSA level that's available. So it's freely public for everyone. We can go to the ColumbiaCompStak.com and you're able to actually download, not only to see the charts, you can also download the data behind it that you can use and do your benchmark and to study research with the data, raw data behind the charts that can be used. Then with that, I guess we can just deep dive into methodology, and Stan can show us how all this great work has been done.
Great. Thank you, Wayne. Let's start with a high-level overview of what some of the key ideas are behind our new index, right? So arguably, standard market practice is to look at simple averages of rents, often in the context of comps. And one key issue when one looks at an average rent is that that potentially hides a lot of underlying compositional changes in the market, right? So, for example, a key problem is with biases potentially in a time of recovery when the market is changing and a certain type of deal is being done in the market, then that could lead to a situation that looks like a recovery but actually may not be one. So let's take an example. Coming out of COVID, a lot of lease activity that was taking place was in the higher end of the property market. Be it trophy office or be it maybe the newest and best industrial real estate building, and that naturally these are typically better sites. They command premium rents, and so to the extent that most of the market activity is in that higher segment of the market, average rents will indicate higher averages because the properties are just better. And so to the extent that there's changes over time in what properties are being leased, what looks like a market recovery, well, looks like an increase in average rents may actually not be one once one takes into account the underlying quality of the asset. And so one of the big picture goals of our index is to remove these compositional effects and really offer an apples to apples comparison, holding the quality of the asset constant. The second advantage of our index is that it helps with end of sample distortions, right? Oftentimes, especially when we're interested in the most recent observation, we want to see where is the market going. And the way data typically comes in is it doesn't all come in at the same time, right? Commercial real estate data often comes in with a lag, but the data points we see first are likely to be the best quality leases, maybe the most high profile deals, the ones that hit the news. Those will enter our data set the first. And again, a similar compositional problem occurs where, the best leases come in first. We maybe have not fully observed all the other leases yet, just because those are slower to come in. And we are led to the erroneous conclusion that the market is rebounding very sharply at the end of our sample, just because we've only seen a very small segment, and in particular, the best segment of the market. So the general issue is that over time, across markets, across sectors, the quality mix of what leases are being done changes over time, and that could at times understate, at times overstate the strength of the market. And so, holding quality constant is really an essential, is a necessary condition to come up with a reliable rent index that is both comparable across time and across markets. So let's take a closer look at how we accomplish this. So the first thing we should talk about is what is our key object of interest, right? So we're going to be working with the net effective rent. Now, many of you in real estate know what that means, but just to be very clear, the net effective rent takes into account not only the starting rent of a long-term lease contract, but also all the rent escalations that take place over the life of the lease. And it takes into account any concessions that the landlord makes to the tenant, in particular, free rent. Usually there's an upfront period of free rent, as well as tenant improvements or work value. So the net effective rent is a single number that takes into account essentially how much the landlord effectively earns from that tenant, from that lease, or equivalently, how much the tenant effectively pays for that block of space. So that's our net effective rent, or NER. And we observe this in the CompStak data at the lease level. So I here is a lease, J is a building, S is a sector, in particular office, industrial, and retail, and then T is a period. Okay. And so what we're interested in is understanding, to what extent, what can explain differences over time across leases, across buildings, across sectors in the net effective rent. As we often do in data science, we're going to work with the natural logarithm so that all changes can be interpreted as percentage changes. Okay, and so that's the left-hand side of our core equation, of our core measurement equation. What's on the right-hand side is really where our methodology comes in. So remember, the idea here is to try to explain why different, you know, office buildings or floors of office buildings or shopping malls are renting for different amounts. And so we have a whole bunch of observable variables to help us account for observed differences across both leases and buildings. So those are the X variables, right? And so just to name you, they're in the box at the bottom of the slide, but to give you some examples, the size of the lease, how many square feet, the length of the lease in months, the type of lease, is this a gross lease, a triple net lease, the space subtype. For example, for retail, there's over 180 different subtypes within that retail universe. We know the building size. We know what floor potentially the lease is on, especially in an office context. And then we also know what the transaction type. The transaction type is this a new lease? Is this an extension? Is this an expansion, for example? Or is this a renewal? We know the age of the building. If we know that there was a renovation of the building, we will reset the time clock. We know the class of building. Is it an A class, A, B, C quality building? And then we know something about the tenant. What is the industry of the tenant? And then finally, we know whether this building is in the central business district or not. So all of these variables enter in X, and they're all observed measures of quality. And even though that is a long list and a really good list, and I cannot really think of a data set that has better or more X variables than the CompStak data set, nevertheless, we worry that we might be missing an important dimension of quality, right? Think about, the finishes of the building or the exact location within a block. One could be on a corner lot, the other could be mid-block. These things matter for pricing, right? And so it's going to be impossible to ever fully observe this with, however many X variables you have. And so a key idea in our methodology is this term, which is called HGFE, hierarchical geographical fixed effects. And so that's our way of capturing all these unobserved dimensions of quality. And so if you could just stay with that slide one more second, Wayne, thank you. Then basically we're going to observe the idea of these hierarchical geographical fixed effects is that we will try to include the finest geographical fixed effect possible for every building, right? So take a particular office building in Manhattan. Our data set may have 100 different leases in that one building, right? And so in that case, we will be able to include what's called a building fixed effect, right? So the fixed effect will be essentially a building specific mean for the net effective rent that essentially allows us to control for all aspects of quality that are not already in the X variable. So if we don't have that many leases for a given building, we will instead estimate a fixed effect at a lower level of geography. The next level is the census block group. That is still a very small area. In Manhattan, it would be literally a block, a city block. in the context of industrial or retail, it could be slightly larger. It's something like 600 to 3,000 people. That's sort of the definition that the census gives to a census block group. If we have enough leases, we'll estimate that instead of the building fact effect. If we don't have enough data points to estimate it, to estimate that census block fixed effect, we'll fall back to the next level of geography, which is a census tract, which is again small but slightly larger than a block group. If we don't have enough leases at the census tract level, we'll fall back to the next hierarchy of geography, namely the county, and then the MSA, and then if we have really very sparse data, which is rare, we'll fall back to the country. Now, when all is said is done, what we're interested in is this intercept, this alpha ST that is in red on this slide. That is our rent index. That is what we're ultimately interested in. And sort of the idea is we're going to estimate this at the sector time level in our national series, and we're going to estimate it at the sector market time level in our city level analysis. So for example, when we're thinking about the national office index, S is office and T is month. And so for every month, we'll essentially estimate that alpha ST. Since our equation is in logs, we'll exponentiate that and we'll get essentially a constant quality rent index in dollars. If it's at the market level, then it would be, for example, Manhattan retail. That alpha will be specific to Manhattan retail and it will be estimated quarterly. So as I alluded to, we have these hierarchical geographical fixed effects, which allow us to essentially control for unobserved dimensions of quality. And ideally, we can do this at the building level. This is our way of using sort of as fine control as possible. We're able to do this for about half of our observations, and for an additional 33% of observations, we can estimate a fixed effect at the block group level. So if you take those two levels together, that's almost 90% of our least level observations where we can estimate a very fine geographic fixed effect. Only in 10% of cases do we need to go to slightly broader and slightly geographically coarser fixed effects like the county or the tract level. What you're seeing on the right-hand side of this slide is the result of our estimation. I'm showing you some regression coefficients, and in particular, I'm showing you some of the coefficient estimates on the observable least characteristics, the variables inside X. Okay, and so in particular, I'm showing you how our index, which is labeled by the column CQR, how our index, how the net effective rents according to our index depend on the size of the lease, how old the building is, how long the lease is, and so you can see, for example, leases that are in the row log lease term. If we're looking at an office lease that is 1% longer will command 4% higher rents, or a block of space that is 1% larger will command 0.3% smaller rent. So that's how you read these coefficients. What I want to emphasize is that we can compare our methodology to a slightly simpler methodology, which is the column hedonic. The idea of hedonic is we're going to put in the same X variables as in our main model, but we are not going to put in this hierarchical geographic fixed effect. So we're going to ignore these unobserved dimensions of quality. And as a result, two things will change. The first thing that will change is the R squared in the last row, the penultimate row of the table will be substantially smaller. What that means is that our model, relative to a rich hedonic model, but that does not have these hierarchical geographical fixed effects, our model will explain about 20 percentage points more of the cross-sectional variation across these different leases. So that is a significant improvement in fit, in goodness of fit. So our model generates much smaller pricing errors, leasing error, lease NER errors than the hedonic model. And that's true across these three sectors. That's point number one. Point number two is if you do not have that hierarchical geographical fixed effect, you will misestimate these coefficients on those different X variables. So the X variables that are in the second column are in some cases very different from the ones that are in the first column. And similarly, if you compare the fourth to the third and the sixth to the fifth column. And so in other words, you'll get biased estimates. You'll get incorrect estimates of, for example, the additional rent for a longer lease, right? So for example, in the office column hedonic, in the row log lease term, we see a coefficient of 0.076. That would lead you to believe that a 1% increase in, if your lease is 1% longer, then that would result in 7.6% higher rents. Well, that's actually not correct. It's only 4% higher rents once you properly take into account these building level fixed effects that are inside our hierarchical geographical fixed effects. Okay, so you get both biased coefficients, incorrect inference, and you get a lot lower explanatory power, even in this rich hedonic model. Okay, so this is a long way of saying our constant quality model does a really good job explaining why different leases command different rents, especially once you have our new aspect, which are these hierarchical geographical fixed effects, which are our way of controlling for unobserved quality. Next slide, please. So just to illustrate this at a slightly more sort of a simple level, let's do a deep dive into Manhattan. And Manhattan is a really interesting market. It's the largest office market in the country. It's also a very large retail market, but let's focus on office here. And so what we want to do in these next couple of slides is illustrate in a simple way the power of our methodology, and in particular, why it matters to control for quality. So what you're looking at here is data from 2017 until the end of 2025 on the net effective rent in Manhattan. And that blue line that you're seeing is the simple raw average of net effective rents. And if you look at that line, you see net effective rents are around $65 pre-pandemic, and then they fall significantly in 2020 from about $73 to about $58, let's say, during COVID. And then we have the significant expansion period in 2022, Q2 and Q3 of 2022, which we call recovery question mark, and another period of substantial rent increase in 2024 between Q2 and Q4. So what we've overlaid here on that same graph is the proportion of office leases that are signed in prime Class A buildings, right? So CompStak has a way of classifying buildings into trophy. So prime Class A here means not only Class A, but within Class A, look at the trophy buildings and look at new construction. And what you can see is that in these two gray shaded areas, when we have this strong increase in the average, in the simple average net effective rent, that exactly in those 2 quarters, or in these 4 quarters, we see an above average share of new leases are being signed in these high quality, in these prime Class A office buildings, right? And so this is a key observation because, again, this is our entire premise. Our entire premise is in some periods, there are just more high profile leases being signed than in other periods. And if you're not careful about that, this will end up distorting the simple average rents upward. And it might lead you to conclude there's a large office boom, whereas there is in fact none. So what we've done is we've overlaid this with our own CCRI, our quality adjusted rent index. And as you can see, exactly in these two gray shaded areas, we see much less. Our index tells us a very different story. It does not tell us a story of strong recovery. It tells us a story of, stable, maybe muted improvement, modest improvement, but certainly not strong rent growth. And the reason is that these large leases that drove the averages in those few quarters were not representative. They were not the average lease that was typically being signed in the Manhattan office market. And once you take that into account, that sort of takes a lot of the wind out of the sails of the recovery, if you want. Right. And so we would argue you need to focus on the black line, not on the blue line, and they can give you very different answers, especially in periods where the composition of new leases that are being signed is not average, is not representative, is not a typical one that we see. That said, if you look at the very far right of the picture, both our method and the raw data would tell us that actually right now, in the last couple of quarters of 2025, we do see, a substantial rebound, where now for the first time since COVID, Manhattan office rents have exceeded their pre-pandemic levels. That's true according to our constant quality.
Thanks, Tim. So beyond that, obviously, the index is very useful for trend analysis to know where the market is going. Is available on the national level, also on MSA level. Uh, we do have a couple more ideas when we're discussing the CCRI internally or with our CompStak clients. There's some interesting applications of CCRI I think is worth to talk about. One is the idea is the efficiency frontier. So basically, CCRI provide an excellent way to measure the trend and of the market. Right, the trend is the rent growth, and if we just zoom into the rent growth, for example, and think about a portfolio theory, what portfolio can drive the best rent growth and rent income, right? So if we use the CCRI and translate the index into the volatility as like x axis here using the standardization of the time series, and we use the compounded growth rate as a return proxy, then we actually were able to quantify each MSA, basically how the performance is in the past. And if we do some simulation, we can plot a portfolio, like simulate portfolio, to see what portfolio composition will yield the best, what is the best performance, right? You can have the max Sharpe value, what portfolio can have the minimum variance. So with this, then as like a portfolio manager, we can actually rethink about our portfolio asset allocation strategy, right? Is that we is the portfolio has enough exposure in the south, or is overexposed in certain markets? Actually, it is a good sort of application. We can use the index and sort of transform it into like a portfolio monitor and a portfolio asset allocation strategy tool. So I think that's an interesting way to look at this. It's like from a portfolio theory perspective. And secondly, there's a study we do against the NCREIF's NPI index. So, as in one of the unique part of this index is based on CompStak's net effective rent, right? So it's actually the rent, the index will drive, will move along the market when the lease is signed. So compared to some indices like NOI indices, what we found is that these kind of market-driven indices will have like a leading effect compared to those NOI driven indices. It's not 100% apples to apple, as we know. Rent growth is one component of NOI, which is a big component, but NOI comes with OPEX and other things into consideration. So it doesn't really move as quickly as the market indicator, like a pure market transaction-driven index like CCRI. So if we lag the CCRI by 4 quarters, what we observe is that the highest correlation actually comes after we lag the index by 4 quarters. So on the right-hand side, the chart is showing basically how many quarters you lag the CCRI index, what's the correlation against the NCREIF's NPI indices. So if we lag by 4 quarters, we have the highest correlation, which is like 54%, which is pretty a high correlation in my opinion already. So this is just another interesting way to look at the index when we're trying to find like a market leading indicators. This kind of index, CCRI, can show a quicker market momentum compared to income driven indices. And lastly, I think this is also a very interesting application is that if we take more than the index, but also just take the index methodology, right? Since they talk about the hierarchical geographical fixed effect, if we take the hedonic regression approach, instead of extract the time coefficient from the model, we can actually also try to use that hedonic approach and to be a more like a traditional AVM like usage, right? So this is this table shows an example in 420 Lexington Avenue, Manhattan. There's a lease that we sign. We in CompState database we see this transaction happening in 2010, but we're missing more values in 2025. Maybe the lease just is vacant, or the lease hasn't renewed yet. We actually can try to estimate what is the like fair market rent almost, right? In this case, what the rent level, the net AER level will be. So I think in this case, it's showing using the model everything other than the age of building, right? It will be remain the same. So only factor here that will be different is the age of a building. So if we apply the hedonic regression, in 2010, the AER prediction will be around $31. But if we apply it now as the building age change, this rent will predicted to be like around $49. I think also more interesting is like for this approach to compare to the traditional maybe like real estate appraisal approach, right? So traditional appraiser will find 3-5 comps nearby around the same square footage, transacted in around the same time, and try to make some adjustment, make a weighted average, and make a conclusion. So this approach can depends on the sample size, can yield very different result compared to this APM kind of approach, right? So in the table, there's a concept we put together just for demonstrate the idea. In this concept, right? Because like there are leases even around the same square footage, around the same time. Some leases will yielding from $50, some will be $80, some will even high, go over $100. However you average it, you can see the variance will be very high, and the conclusion can be very different from this this methodology. So I think this provides an interesting application of a CCRI methodology, not necessarily the index itself, but just the methodology itself can provide a different view to the to the traditional real estate appraisal approach. So yeah, that's the last interesting application I think I want to share today. And before we wrap this up, Stan, since I have you here, when we're showing these indices to our clients, there are some questions coming up. So I think it's a good opportunity to ask and clarify that. I believe some audience will be interested to know as well. So, so definitely the most common question that we get is that how do we interpret the index value, right? The index value will show, for example, maybe Q1 is $20 and Q2 is $21. What does that really mean? Is it like a net lease basis? Is it gross lease basis? How does the lease type really being addressed in the modeling process? How is that a number? Can we plug and play? How do we really interpret the indices?
Sure. Thanks, Wayne. So the one thing we need to remind, that's a good question, and I think the first thing to keep in mind is that one of our key control variables in the methodology was the lease type. So we are never comparing apples to oranges. We're never comparing gross leases to net leases. Instead, the model knows that it estimates the average differences between net and gross leases, and sort of it properly adjusts for the difference in contract types and lease contract types. Now, we thought it was important to express our index in dollars because that's very intuitive. That's how people think. So what we've done is we've estimated our index, but then we've essentially normalized the index in a particular year, in particular in 2019 Q4. So what we do is we take all of our leases in a given market, let's say the Manhattan office market, and we calculate the raw average net effective rent in 2019 Q4. And that becomes the anchor for all of our leases before and after. So you could think of it as we could have normalized it at an index level of 100 instead of the actual average dollar amount. And then the index will tell you percent appreciation before and after that in that base period, right? So one way of thinking about it is relative to some average office market rent of say $75 per square foot in the Manhattan office market, how much did the lease, the net effective rent appreciate since then or before then? So everything is is relative to some average base period, which is going to be some average of net and gross leases. Now, if the user is specifically interested in, let's say, gross leases, then it would be very easy to calculate what was the average raw gross lease in the base period, and then sort of calculate the index from that point forward relative to that alternative base observation, which would be a different one from the one we ended up using. Okay, hopefully that clarifies it.
Yeah, thanks. Yeah, I think that clarifies a lot. All right. Hopefully this is a informative session for everybody, and definitely want to encourage everybody to take a chance to look at the indices on ColumbiaCompState.com. Everything's available there. You can download the data, plug into your own analysis and see if that's helpful. I really think this is an interesting way to make the industry a little more transparent and make a more clear indicator for everybody to use. So
one more thing, there's also a methodology paper available on that same website, which details this methodology in great detail. It's a more technical working paper for those who are interested in really digging into it. That paper also has additional applications of the index to, for example, look at correlations with employment growth or population growth or residential house price growth between our index and these alternative macro series.
that's a great call out. Definitely feel free to read up to the details. So thanks again for everybody to join and have a good one. Thank you.